on the 14th. Happy Monday, everybody. Let's get started. First things first, we want to use risk in trading. Please and always use trade capital only. Do not trade with money you can't afford to lose, whether you're trading stocks, options, futures, forex, and cryptos even. You know the deal. All right. If you're following me on social media, make sure it's the real me. I just got word of this last week. Somebody was claiming like, oh, Chris, have you talked to somebody on YouTube and done this with Facebook and asked me about this? I'm like, no, that's not what I do, right? You want to follow me, follow me. You want to ask me questions, you ask me questions, but you're never going to get a message from me first, right? Especially about some garbage scam solicitation, too good to be true. It's like, come on, man, use some common sense. So youtube.com/Chris Pulver, Mondays and Fridays for the live Pulver Report. I stream, the same session on Facebook, on Instagram, on Twitter. I'm becoming way more active on Twitter, so if you want to follow me at Real Chris Pulver, starting to tweet out on the reg. So check that out. Yeah, that's it. But any suspicious stuff, just report them. It's not me. All right. Okay, let's get to it. Here are the charts. Lot to review this week. So market threw in a bit of a kitchen sink rally last week. It was, the market getting all excited about CPI data. Again, it's nowhere near where it needs to be, right? And this is probably the harsh reality that nobody really wants to hear. But it doesn't really change anything. Okay. I mean, yes, the market rallied hard, and there's the timing of this year and the desperation to, have some type of positive run for Q4. Maybe we have enough to drag us into the holidays, right? But I do think that the Fed speakers are lined up this week, which is kind of annoying. And here's one of them right here, literally Monday morning, 11:30. Brainerd speaks. Now, is that enough? Is he going to say like, wait? This market can't rally. Nothing's changing. We're still raising rates, higher for longer, blah, blah, blah. The Fed could throw I don't know. I was going to say a fart-scented towel on everything. I don't know. But yeah, I mean, the Fed can totally squash what the market got excited about last week with a 0.5% improvement on the CPI data. So yes, we had improvements on month over month. We had improvements on core CPI, but 7.7 is a long ways away from the targeted 2%. So unless, and this isn't going to happen, okay, unless the Fed's like, you know what, we can operate in this 3 to 4% inflation target, maybe that's better. But what the Fed is wanting to see is they want to see continued improvement in CPI data and core inflation numbers. They also want to see a drop in employment. Okay, they want to see a drop in spending. They want to see a drop in prices because a lot of signs are also pointing towards a recession in the halfway point or even the later point of 2023. Right, we've had an inverted yield curve for I don't know how many months. If we do the 10 and 2 right here, the 10-2 Treasury yield, we're still deep. I mean, this is nuts, right? Look at this, deep reversion. Let me see if I can find I've got a chart on here that has all of the yields, 10, 2, and 3 month. Yeah, this is a big one. So check this out. Okay, the 3 month, let me do percentages here. I guess I'll just do regular. Okay, so my 10-year versus the 2-year versus the 3 month. And I suppose I can let me throw on the comparison here for the US 10-year. There we go. Let's throw this in there too. Okay, so what do we have? Well, we have the 10-year at 3.85. We have the 3 month at 4.19. A 3 month inverted with the 10-year has 8 of 8 times called a recession. So there we are. 3 month over 10-year inverted yield curve. The 2-year over the 10, it's 4.1 on the 2-year, 4.41 on the 2-year to 3.85 in the 10-year. Again, very commonly calling recessions. Now, there's always like that 6 to 60 month window. So take us into 2023. We're likely going to have a recession. Now, I said this about a month ago. Does the Fed want a recession? Because it's probably going to happen. Or does the Fed want a recession plus high inflation, plus no growth, plus, you know, shrinking nominal GDP. If all these things are lining up, that's not a good thing, right? So look, the Fed's going to still play hardball in the narrative. We should we should know that, be braced for that. If the speakers this week are going to start smashing down the excitement from last week, it would make sense. So 8% was forecasted. I saw 7.9, and then it printed 7.7. Right? We typed this out last week on Monday. If the CPI prints year-over-year 7.7 or less, market expects to rip higher. Now, I'm wondering if this week we have a major monthly expiration on 11/18. Is it enough to keep the market floating higher? One thing we can also go into. Let me bring a screenshot. This is an ominous little gem that I think we should all be aware of. Let me bring it up on Telegram because it doesn't look great if you think about it. All right, so let me get down to the daily time frame. Let's say hi to everybody. And then I've got a nice little picture
I suck
here.
at sleeping,
Give me a sec.
but I'm not a...
All right. So, Derek, just what's happening? Brad in the house. David, Donna, Thomas, Gary, Tim, good morning. Cold air in Alabama. Oh, boy. Sterling, good morning. Joe, good morning. Ruth Ann, good morning. Andrew, good morning. Bill, what's happening? Thanks, Bill. Morning, Craig. Morning, Jason. How do you do? How do you do? What's up, Chris? Okay. So, let me show this. Okay. This is the one thing that keeps sticking out. You know, this orange line right here that you see, you know, juxtaposed to the 2008-2009 S&P, it doesn't look that great, right? Because if this is where we're recovering, this would be our, you know, September, October low, and here we are. So have we taken out these highs yet? No. Do we still have a sell zone up here? Yes. 2008, 2009, and this would essentially be, okay, look, current is 2022. So does this look like 2023? I don't know. Maybe. So, I mean, are we in worse shape than 2008? I don't know. I think there are different factors. I think that this has certainly felt a lot more like a blend between, you know, 2000, 2001, the reset of tech, you know, the reset of just crazy fantasy valuations, the concentration of better companies to rise to the top to kind of carry the S&P. But you know, when you got your bellwether mega cap techs, your Amazons, your Apples, your Netflix, your Googles, your Facebooks, Meta now, right? When all of them have just been hit so hard, 40, 50, 60, 70% corrections, that has 2001, 2002 written all over it. 2008, 2009, you know, we're seeing the affordability index for housing in 2022 down to the lowest levels. Anyway, there's correlations to draw from each. So is this where we're going to be in 2023? I don't know. Maybe, but fudge, man, who knows? So if there's any way that we can take advantage of this to you know, keep us at least somewhat better off to finish out Q4, I'm sure that's going to put some smiles on bulls' faces, right? But I'm going into 2023 with this potential caution, just in case. You know, I don't want to get stuck with a bunch of stocks that drop in 2023. I want to trade a bunch of options. Our currencies, we've got to be aware of what's been happening this entire year with currencies. There's been a big flow in the dollar. The one big note from last week is the 2-year, right? If you look at the 2-year yield by itself, we had a pretty nice drop from 5 point. This is the 2-year. That's weird. I don't know why this was adjusted. The 2-year had a spike at 5.14, unless it was the 3-month. Hang on. 3-month? No. What the heck? Did they change the price on that? This spike up was 5.14 last. I mean, I was looking at this all week because I thought, you know what? Maybe if the market is trying to anticipate that 5.25 interest rate, that's been adjusted. But anyway, now it's showing a top at 4.87. But well, I don't know. I know I'm not taking crazy pills. That was 5.14. Nevertheless, that's where we're at. Okay, the Fed expectations. We'll take a look at that Fed Watch tool, CME. Morning, Tim. Morning, Jan. Morning, Bob. How are you? Tony, what's up, dude? How are you? All right, here's Fed Watch Tool. So we don't really have an official Fed meeting until December 14th. Now, that official Fed meeting would be the rate decision. Its highest probability is going to be a 50 basis points hike or 0.5%. And then we're looking at a split between another 50 basis points or 25. This is a split going into February. I'm sure the Fed's language in December will tell us more. Possibly the Fed speakers this week will tell us more. Maybe. All right. But here's what I'm watching. Okay. The 2-year, if we make a fresh low, that would be exciting. I'm going to set a chart on now at 4.88, see if that's going to come back to the highs. And I will be watching currency wise, dollar yen. Dollar yen, we have a nice little pullback. I'm still short on the dollar yen and I'm fading this move. So I'm looking for, if the dollar yen pulls back into this window, I'm looking to fade this for one fresh low into this EMA cluster. These previous lows is 135 to 134. That's my profit window. And I would be pretty happy with that overall. Let's look at the DXY, same thing. A little bit of a pullback on the DXY, but this 200 EMA is sitting right here. So this week I could see a pullback on the DXY and then a follow through, whether it's the same week or we have, this week's a pullback, next week is follow through. This week pullback deeper, next week follow through, right? So we're gonna have to see how long this kind of bull market wants to rally, right? So if this is a correction, maybe we pull back to that weekly pivot, that would make some sense. So that's what I'm eyeing this week. If we can break some fresh lows, that'd be pretty exciting, at least for some follow through. We had obviously a great 48 hours last week on Thursday and Friday, favoring dollar weakness, which gave a rip to everything. Because the dollar got weaker, you saw a really big jump on gold, right? Gold, huge move to the upside. Off these recent lows, gold is up, almost 10%. Silver, another big move off the lows. Silver up around 17.5%. Even with all the Bitcoin drama going on, we're trading at 16.7. We didn't break any fresh lows yet. It's around 15.5. So let me set some chart alarms there on Bitcoin. Ethereum holding steady. We had lows around 1075 tested. We're going to see what old crypto brings us this week. If there's more drama coming out of the FTX / Binance, I know the deal fell through. Look, it's certainly a blemish on the industry, right? I mean, crypto software is not the same as Bitcoin, all right. But right now, it's kind of the Wild West, and we don't know what the overall ramification is going to be if they try to ramp up regulation, if they try to, I don't know. It's really uncharted territory. So just continue to, if you're investing in crypto, if you're investing in coins specifically, I have switched essentially my entire crypto holdings into Bitcoin, Ethereum, and the only one I have that's non-Bitcoin, non-Ethereum is Ripple, and that was prior to the SEC probe. So Ripple is XRP. I'm still hanging on to a decent chunk of XRP. We're back down to the lows. My cost basis on this is 17 cents. So I'm just going to sit tight. This could be a long ways away from ever getting back to the highs. But anyway, I mean, just a massive flush out of I mean, people just lost money, period. It's been, like I said, a blemish on the industry. It's a stain. And I don't know. I mean, now you're seeing all the. Were there any signs? And it's like, yeah, there people were skeptical, several years ago, and all of a sudden they can play those on a loop and see, I told you. It's like, yeah, that's great, but I mean, I don't know. It's unfortunate that things like FTX have happened and things like the stable coins breaking have happened, and but guess what? They weren't real in the first place. I mean, if they're not doing what they say they were doing, that's fraud, right? And I mean, people are going to be in a lot of trouble, and I'm sure this is going to take years to right. But anyway, just be super freaking careful on the potential like crypto-based scams. I'm sure now people have woken up enough. Like this is the third, fourth, fifth time this has happened. Um, yeah, it's just be careful. That is all. Okay. Okay. So let's look at oil prices. Oil trading at 87.73. Do we have official results from the 2022 midterms? Is the Senate decided yet? It was like 48-48. Still interesting. So we still going here? So Georgia's a big one. Runoff tie. Okay. We had flip in Pennsylvania. Huh. I mean, I'm trying to look. It says lead, but it's so lightly shaded. I can't really tell with the other states. So, the House flipped, right? House is Republican by a slim majority. The Senate, I don't know if this is done yet or not. So, is it done? 50 to 48? Yeah. And I don't know. Is this enough? Maybe. Is this still? Well, even if it is, right? If we're done and Senate's Democratic, you're still favoring or you're still going after a Republican House. So there's your gridlock. Again, and I mean everyone's saying like, oh, this is good for the markets. Like, yeah, is it though? You'd have a lame duck, non-functioning, stale government. I mean, yeah, it's good you can't just power through spending bills, but at the same time, it's like, so we just don't get anything done or anything accomplished, and the stuff we do is, earmarked with footnotes and just all sorts of wild stuff that gets pushed in and stuffed into the last minute. I mean, how many bills have we seen that do that? So whatever, man. I mean, politics is so annoying. Anyway, hope you did your duty and voted, but here's how it shakes out. So, Democratic Senate, Republican House, gridlock. I suppose right now in the near term that's good for the markets. Um, Oil, chart alarm, chart alarm. Let me see. This is around 94. I'll set one at 94.20. 94.25. It's 94.25. 94.25. See if we can get a fresh break above these highs. Recent lows. Let's go down to 81.50. 81.50. And just get some oil prices surrounded. Gold, silver, we took a look at. We'll be watching the dollar. So again, this is pretty much how I'm lining up my week. If the dollar is going to have this brief pullback, great. I want to see this. I mean, sooner than later, I would like to see this dollar hit this 200 EMA, right? We've closed below the 144. Let's go after the 200. Even if we have a little pullback here, looking for another low to hit that 200. I am trying to protect as much profit as I can on this. I ended up clearing out about 2,500 pips last week, 2,552 to be exact on my manual trading. My robots made an extra 1,800 pips, so it was a fantastic week last week. I felt like Tony out there clearing thousands of pips. So it was a decent little total. It was like 4,000 some pips last week. But again, I don't celebrate that like, oh, look at this, what a great week. It's like that's been months in the making. So it was nice to have a big cash injection. I'm still aggressively looking to fade some of this dollar stuff, and hopefully I'll be taking profit sooner than later on some of my remaining positions. Dollar yen is one of my remaining positions. Euro dollar, if we have a pullback here, I'm doing the same thing. So if we have a pullback towards this weekly pivot or pullback towards this breakout, I'm looking for this to go up just a little bit more and try to find that 200 EMA. Right? We have room into this, 104 to 105 zone on the euro dollar, 104 to 105. Make sure you're protecting profits there. If we see just another big kick to the dollar's face, then maybe we get up to 110. But I think that 105 is probably a pretty good effort. I mean, that is essentially 1,000 pip recovery off these lows. And corrective wise, that's pretty good, right? So anyway, watch the 200 EMA. We talked about this last week in several sessions, including the Flex Trading Room. These are my daily targets. These are all big numbers that we've been going after, and it's right around the corner. So hopefully the DXY delivers on it. And that should, for this week, that should be enough. If the dollar's going to get a little bit softer this week, that should be enough to sustain this little rally. So we're at 397 on the SPY. We close at 398.51. Can we get up to this 200 EMA? Can we get back up similar to what we did right here? We have resistance. We have resistance. Going into this week, Friday is the 18th. Next week is Thanksgiving. So if we can stick through this week, if we can get through this week, then we can possibly get into, a little holiday drift. And then December is going to be kind of the reality. Do we still have a Santa Claus rally? Do we still not? I don't know. Depends on how vocal the Fed's going to be coming forward. And we have some speakers this week we'll have to be a little bit mindful of. Okay. All right. Yeah, thanks, Ken. Yep, thanks, Bob. Got that. Yep, cool. Okay, so good on that. Expirations this week. Take a look. Actually, I'll bring in here's my trade doc for equities on demand. I think we've done quite a bit of management already. Let me sign into this really quickly. We did quite a bit of management on this. Right there. I was going to look at my 11/18 expirations. So let's go 11/18 expirations. So I have 30 expirations that I need to be managing this week. Now, some of these we've already taken care of. We're going to look at everything this week. So class at the top of the hour for equities on demand, trading stocks and options. We have 30 different symbols to get through. We probably managed about 12 of them last week. I ended up closing quite a few for profit. So we had a break even on AEO. We took profit on corn, took profit on the VIXM, profit on KHC, profit on GLD. We added a couple extra trades. We took profit on, our bonds are looking better. TLT, IEF looking pretty good. Okay. So anyway, we have some good looking trades. And with some of our expirations right now, we're in good shape. I know that this week, SLB is going to be in full profit. HAL is going to be in full profit. USO, I think we closed out USO for a small win last week as well. Looks like I didn't put that out. I know we closed out USO somewhere. But anyway, it's going to be a busy week for stocks and options. Currency-wise, Masterflex is off and running, and we're having some great success with that. We had great two classes in a row, Friday, and plenty more to talk about this week. So anyway, that's it. Any other charts you'd like me to take a look at this morning? Hey, Herbert, how are you? Anything in particular? What we could do is just take a look at our direction. So the SPY this week, like I said, going after this 200 EMA. I said last week 405 to 410. If you're looking at where the bulls can make a run here, they can kind of breach this 400 area, then take the SPX up to 4,000. But just I'm going to be very protective there. We start making a little run here. That's great. I'm hoping we can carry this bullish trajectory up into the expirations on Friday the 18th. There are some stocks that I will get called away for profit. There are some credit spreads that will be generating some income. I'm still going into the rest of the year somewhat cautious. If we have like holiday rally and we get up here, exciting, that's awesome. Save Q4. But the reality is, if CPI talk and Fed talk is still firm and still pessimistic, then we're probably coming right back down into, I don't know, this might be a high that we established. This might be a low that the market comes after again. But we'd have to have a pretty awful earnings compression. I did see that growth overall. What was I reading this on? It was on Data Trek last night. It was like 61% of the S&P was reporting positive earnings, which is lower than average. Like usually it's 70+%. The amount of upside is also quiet. So we're seeing even though they're positive earnings reports, they're not as positive. So take it for what it is. It's just stuff you got to be aware of, you know. And based on that crazy deep 2 and 10 year yield curve, sign of recession, 3-month and 10-year, eight out of 8 recessions called, and we have a 3-month and 10-year inverted yield curve as well. Yeah, and we know the Fed's not going to stop raising rates. There's not going to be a Fed pivot. All right, there might be a Fed pause. That pause isn't coming until, and again, pause meaning like they'll just stop raising rates. But higher for longer isn't good. If the Fed gets to 4.5, 4.75, 5%, and they stay there for the next 6 to 12 months, that's not good. And I think the market's anticipating they're just going to start cutting rates, and I don't think that they will. So look, either the only way the Fed's going to pivot is if they tolerate higher inflation, and I don't know if that's good. But we're like on the brink of like stagflation. We're on the brink of hyperinflation. We're on the brink of deflation. I don't know what the heck's going to happen, and nobody else does either. The Fed doesn't know what's going to happen. I think the Fed is hoping that we can get a hold of energy, but we haven't even seen this winter is coming type stuff on energy. I mean, prices are quiet, I guess, but they can certainly spike. Listened to an interesting podcast yesterday, just caught up on some of the inserts of green marbles, and just talking about Russia's incentive to keep this same tension and friction brewing as long as possible. Why? Because it's going to keep energy prices higher. It's going to be a benefit to them, and they have no incentive to go back and fall in line and be, an ally to Europe in the Eurozone. So, and we could have a direct face-off between, Russia, China, which brings Mongolia into the picture. China, Taiwan, we've been, hearing rumblings about that because Russia invades Ukraine. So China, Taiwan, that could be a target. But Mongolia is a commodity-rich nation that sits right in between Russia and China. So there's another one that could be potentially an issue and problem area. And you talk about nuclear threats and stuff like this. I mean, geopolitically, it seems like we're as tense as we've been in a long time. Between Russia, China, the Middle East, the U.S., things are a little bit gnarly. So guess what? We get to digest all that as traders and investors too, right? And have a blast. So as I said, plan for the best, prepare for the worst, cautiously bullish. Make sure if the market wants to do this, okay, if the market does this, I'm talking just in general. Market goes up, market goes down, risk on versus risk off. How does that affect your portfolio? I want to be positioned in a way that it doesn't matter. Can we generate income doing this? Can we protect ourselves on the downside doing this? I hope so. That's how I'm trying to position everything. Trading stocks and options, even trading Forex now, able to get out some of those dollar pairs and looking for a little bit more of that dollar weakness to hopefully finish up this week or next week. But if the market goes up or down or sideways, I want to make sure that my portfolio is airtight. Okay. All right. Hey, Gary. Hey, Paul. How are you? Any questions? Any questions? We can keep it pretty brief today, this week. So Tuesday, Wednesday, Thursday, Flex Trading Room, Master Flex on Friday. We'll be actively looking for some opportunities. I'll be watching the currency strength in the morning. If we get some another run of dollar weakness, we can come back and maybe find some of those weekly pivots in the near term. But if we see another push of dollar weakness, I'd be super happy with that to finish out some of those bigger targets. I also would like to see the Swiss franc get a little bit softer at some point. The JPY had a big run last week. This was Friday last week. So Swiss on top, yen was second, but the dollar was the weakest, and that was a big move last week from Thursday, Friday. So any additional follow through on dollar weakness would be fantastic. I'm going to keep an eye on the Swiss and the yen. That's another currency pair that I'm watching closely is the Swiss yen. Historical highs, 30 plus year highs, and we'll see if that comes back to balance at all. Euro Swiss, pound Swiss have pulled back. But anyway, we're going to keep the pressure on the dollar at least for this week. 11/18 expirations are big. We're going into a holiday week next week. So it's going to be important to watch. Okay. Yes, thanks, Donna. Yeah, if everyone would kindly, if you're checking it out, it shows that I've got one person watching, but I know that's not true. We got a pretty busy chat. So anyway, for everyone watching or watching this recording after the fact, hit the thumbs up button for me. Please support the channel. Algorithm likes it. I like it. And yeah, youtube.com/Chris Pulver, Mondays and Fridays for the Pulver Report. And you can follow me on Twitter as well. Twitter, it's at Real Chris Pulver is my handle. And I'm going to start posting some charts this week. So there you go, at Real Chris Pulver. Posted a couple last week on currency strength. So like I said, way more active on this because I'm just going to keep it on the desktop and do my thing. All right, so elections are good enough, done, over with. Let's see what the Fed speakers talk about this week. We'll be watching currency strength trading actively in Flex Monday through Friday, stocks and options, and equities on demands. And it's a very busy week with 30 expirations, so we've got a lot to talk about. And moving forward into end of this year and into Q1 and into 2023, I'm probably going to build one of the more boring bulletproof portfolios where I'll be focusing on financials, probably industrials, probably energy, probably materials, all the value stuff that when tech money is leaving and exiting and going somewhere, it's going to go back into the boring stuff. And so I like boring. I like making profits when it's boring. Seems a little bit easier, not as chaotic. It shouldn't be stressful to be making money when you follow a process. So it could be, interesting how the market finishes the year. Do we have Santa Claus rally show up? Is it now? November, December, do we save Q4 with a little holiday rally and the Fed stays quiet till December 14th? Or do the Fed start chirping now and then the 14th is just more of the same? Higher for longer. They're going to reiterate their stance on, tough monetary policy and tightening. There's a lot of, there's trillions of dollars that are not backing the market right now, right? So you still have an interesting dynamic between, where equities go and the bond market. We had a big turn last week on the TLT, right? The TLT trading at 97. We had recent lows at 92. The IEF is a 7 to 10 year. That turned really aggressively from 92 and change to 95. The SHY, this was in the 80s, but we turned, from 80, 60 up to 81. Big trades on the FXY, which is still running, by the way. So we're at 66.50. Our FXY is up a few $100. We collected $9 and change on this credit spread. So we'll be up a few $100 on this one. AT&T was another surprise that I saw last week as well. AT&T is up at 19.13. We have a 20 by 15. We're going to talk about that this week for some potential profits. We had a 20 by 15, and we're in, I think it's of the $3 and change, $4 or something we collected. It's up like 70%, 75%. So we might be projecting profits on AT&T this week. So good stuff. Let's see here. Yep. Oh my gosh, Daniel, I feel so bad, dude. You've literally been telling me that for weeks and reminding me. I'm sorry. I know. Look. I know I'm busy, and I probably taught 30 hours last week and traded and everything else. But yeah, I will put it to the top of the inbox and put it on my to-do list for. I'll say this week, but I'm going to try to do it today. I know I teach all day until like 4 o'clock, but I will try to do it this week. Yeah, there you go, Derek. Boring is good, right? Boring is good. All right, for sure. All right, everybody. Thanks a lot for being with me today to kick off the week. Let's have a good trading week. Equities on demand, as soon as I see you at the top of the hour. Tuesday, Wednesday, Thursday, flex traders, and Fridays, master flex. Let's have a good trading week. Okay. All right. Talk to you soon. Bye.